So welcome for this session. This is Mr. John Mark. So I want us to look at financial statement analysis. That's the topic we'll be discussing. And the financial statement analysis, I want us mostly to focus on the financial ratios. Financial ratios. Now when you talk about the financial ratios, they are just an expression to do an analysis so that you can come up with a summary on the presentation of the financial statement. You know, in financial reporting, what happens? You present the financial statement. Now that financial statement, we have the income statement, we have the balance sheet. Those are the major financial statements. So in this case, if you want to analyze so that you can get some summary, so how do you analyze that? You analyze that one you are using the financial ratios. And financial ratios are classified into 5. Number 1, we have the investors or valuation ratios. Number 2, we have the liquidity ratios. We have the gearing or the leverage ratios. We have profitability ratios, and then we have the activity or efficiency or turnover ratio, also known as the asset utilization ratio. So let's start with the first one. That's the investors or the valuation ratios. And now these are the ratios which are used to determine the value of the company. So we're saying that there are ratios which are used to determine the value of the company. They include, number 1, we have the earnings per share. And how do you determine the earnings per share? Now to determine the earnings per share, you take the earnings attributable to ordinary shareholders. That's the profit after tax minus, in case there was preference dividend. Then you divide by the number of ordinary shares. That's how you get the earnings per share. The total earning or the profit after tax minus preference dividend, then you divide by the number of ordinary shares. Then you have dividends per share. How do you get dividend per share? To get the dividend per share, you take the total dividend declared, then you divide by the number of shares. Then we have the earning yield. Now the earning yield, it shows the proportion or the percentage of earnings for every amount invested. And this is how you get the earning yield. You take the earnings per share, you divide by the market price per share. Also you have the dividend yield. Dividend yield shows the dividends per every amount invested. So therefore to get the dividend yield, you take the dividend per share over market price per share. Now what you can note that for both the earning yield and the dividend yield, the denominator is the same, is the market price per share. Then we have number E, that's the dividend payout ratio. So how do you determine the dividend payout ratio? Now dividend payout ratio, you just take the dividend per share, you minus the earnings per share, or alternatively, to get the dividend payout ratio, you take 1 minus the retention ratio. You minus the retention ratio. Then number F, we have the dividend cover. Now dividend cover, it's used to determine the number of times the dividend is paid out of the earnings. And this is how we get the dividend cover. You take the earnings per share, you divide by the dividend per share. It shows the number of times. So this one should always be the number of times. And then lastly, we have the price earning ratio. How do we get the price earning ratio? To get the price earning ratio, you take the market price per share, you divide by the earnings per share. So now let's do some illustration. Let's do June 2013 question 1B. The question is already in your notes, so let's use the question in your notes. June 2013, question 1B. And you're told that Davidex Limited share has a nominal value of 80 shillings. Nominal value is the same as the par value. The company pays 10% of the nominal value of the share as dividend for the year. So therefore, the dividend per share, we are told that they pay 10% of the nominal value. And the nominal value we are given is 80 shillings. So therefore, the dividend per share is 8 shillings. The current market price is 160 with 15% earning yield. Market price per share is 160. Dividend yield you are given is 15%. Required, number 1, earnings per share. So how do we get the earnings per share? Now you say that earnings per share, you take the total earnings, you divide by the number of shares. In this case, we are not given the total earning, you are not given the number of shares. So, but we are given the dividend yield. How do we get the dividend yield? We are saying that to get the dividend yield, you take the dividend per share, you divide by the market price per share. So that's how we get the dividend, that's how we get the dividend yield. Are you given the dividend? Sorry, this was the earning yield. This was the earning yield. Earning yield, earning yield. So this was the earning yield, not dividend yield. So therefore, how do we get the earning yield? To get the earning yield, we say that it's earnings per share you divide by the market price per share. So the requirement here is the earnings per share. So can you be able to make this the earnings per share the subject? You cross multiply. So therefore, to get the earnings per share, you'll take earning yield, you multiply by the market price per share. And the earning yield we have is 15%, and the market price per share is 160. So 16 plus 8, that's 24. So you have 24. So that's the earnings per share. Number 2 of the question, we have to compute the dividend cover. And we see that the dividend cover shows the number of times the dividend is paid out of the earnings. So therefore, to get the dividend cover, you take the earnings per share, you divide by the dividend per share. Earnings per share you have computed here is 24. You divide by the dividend per share, and the dividend per share here we had was 8, of which you have it's 3 times. Remember, we said that the dividend cover shows the number of times, so it's 3 times. Then lastly, number 3 is the price earning ratio. Price earning ratio. How do we get the price earning ratio? Is the market price per share you divide by the earnings per share. And we have the market price per share is 160. Earnings per share, we have computed earnings per share, we have is 24. So the price earning ratio will be 6.67 is to 1. That's how you determine the price earning ratio. So you can see to another illustration, November 2015. November 2015, question 3A. Also the question is in your notes. The following information related to Mogwe Limited for the year ended that 1st of October 2015. Earning yield is 25%. Dividend for the year, 10% of the share nominal value. So therefore, to get the dividend per share, we are told is 10% of the nominal value. How much is the nominal value? The nominal value per share is 40 shillings. So therefore, nominal value is the same as par value. So therefore, the dividend per share is 4 shillings. Market price per share. So the market price per share we have is 150, and you are given the earning yield was 25%. Required number 1 is the earnings per share. So that's to get earnings per share. To get the earnings per share, it's equivalent to earning yield you multiply by the market price per share. So you'll take the earning yield, you multiply by the market price per share. The earning yield is 25%, and market price it's 150. With that you'll get an amount of 37.5. Number 2, dividend cover. Dividend cover, you see that shows the number of times the dividend is paid out of the earnings, and therefore to get the dividend cover you take the earnings per share, you divide by the dividend per share. Earnings per share we have is that 7.5, and then the dividend per share here we have is 4. So you have how many times? You have 9.375 times. And lastly is the price earning ratio. Price earning ratio is the market price per share over earnings per share. How much is the market price per share? Market price per share we have is 150, and we have the earnings per share which is 37.5, and that you get 4:1. That's the price earning ratio. So that's how you determine that. So now let's go to the second category. The second category of financial ratio is the liquidity ratio. So I have looked at valuation of investors ratio. So number 2 is the liquidity ratios. Now liquidity ratios, they are ratios which indicate the ability of the company to be able to settle short-term liability or short-term obligation when they fall due. Yeah, they are ratios which indicate the ability of the company to meet its short-term obligation, and they include, those are the sum of, these are the simplest and easiest ratio we have, the liquidity ratio. Number 1, we have the current ratio. Now the current ratio, it shows the number of times the current liability can be paid out of the current assets. And this is how we get the current ratio. You take the current asset over current liability. And for the current ratio, the recommended ratio is 2 times, or 2:1. That means the current asset should be as twice as the current liability. So that's the recommended ratio for the current ratio, 2 times or 2:1. Then number 2, we have the quick ratio or acid test ratio. And in this case, this is how we get the quick ratio. You just take the current asset, but in this case, you eliminate the stock. So why are you eliminating the stock? Because it's hard for you to convert the stock into cash when the amount is required. So it's not that highly liquid. Stock is not that highly liquid. So therefore, you take the current asset, you multiply, you deduct the stock, then you divide by the current liability. And in this case, for the quick ratio, the acid test ratio, the recommended ratio is 1:1. That means the current asset excluding the stock and the current liability should always be the same. And then number 3, lastly, we have what we call the cash ratio. Now, cash ratio, it shows the number of times the current liability can be made from the most liquid asset in the company. That's the cash and cash equivalents. So therefore, how do you determine the cash ratio? You take the cash and cash equivalents, you divide by the current liability. Now, when you talk about the cash and cash equivalents, so in this case, it's the current asset, you less stock, you less debtors. So anything under the current asset, which is not stock, which is not debtors. Now, for example, you might be having the financial asset at fair value, you might be having the cash, we may have having the bank. Now, those are what we call the cash and cash equivalent. Then you divide by the current liability. So what you can note in the current ratio is that all their denominator are the current liabilities. So that's the second category of ratios. Now we go to number 3. The third category of ratios is the gearing or leverage of the capital structure ratio. Now, what are those ratios? Now, they indicate the extent to which the company has borrowed fixed return capital in order to finance their assets. So it shows the extent to which the company has borrowed fixed return capital. In short, we are talking about the long-term liability and the short-term liability. And they include, number 1, you have debt to equity ratio, also known as the capital gearing ratio. And how do we get debt to equity ratio? You take the long-term debt, that's the non-current liability, then you divide by the equity, you multiply by 100%. And how do you get the equity? Now, equity is the ordinary share capital, share premium, retained earnings, and any other reserve, but not the preferred share. That's how you get the equity. The ordinary the ordinary share capital, the share premium, and the retained earnings. That's how you get the debt to equity ratio. Number B, we have the debt ratio or the financial gearing ratio. Now, for the debt ratio, it takes into consideration all the debt. That is, you take the total liabilities, you divide by the total asset, you multiply by 100%. Then number C, we have the fixed charge ratio. Fixed charge ratio, you take fixed return capital. When you talk about the fixed return capital, these one include debentures and preference share capital. Now, in this case, you don't include a loan. Why? Because we are talking about the fixed return capital. A debenture is always attached to a given rate. For example, you may be having 10% debenture. That means the interest will always be 10%. The same with the preference share. Those are what we call the fixed return capital. Then you divide by the total capital. Then you multiply by 100%. Then number D, we have the interest cover ratio, also known as the time interest ratio. Now, and how do you determine the interest cover ratio? You take the EBIT, earning before interest and tax. It's also known as the operating profit. Then you divide by the interest expense. And lastly, we have what we call equity multiplier ratio. Now, equity multiplier ratio shows the relationship existing between the total assets and the equity invested in the company. So therefore, to get the equity multiplier ratio, you take the total asset, you divide by the equity, and then you can multiply by 100%. So I want us to do this question, May 2012 question 4A, May 2012 question 4A. The question is already in your notes. So now let's do that. May 2012 question 4A. And we are told that the following statement of financial position was extracted from the books of XYZ Limited for the year ending that 1st of March 2011 and 2012. So we have two financial year. So we have the assets and non-current assets, equity and liabilities. Let's go to the required. The total debt ratio for year 2011 and 2012. The total debt ratio. That's the debt ratio. That's not debt to equity ratio. That's the total debt ratio. And how do you get the total debt ratio? We'll say that you take the total liabilities of a total asset. So in this case, we have two financial year. We have 2011. Also, we need to compute for 2012. And number one, the requirement is the debt ratio. And how do we get the debt ratio? We'll say that is total liabilities. Total liability, that means the short term, that means the non-current and the current liability. Then you divide by the total assets. Then you multiply by 100%. So now let's compute that. Let's start with 2011, total liabilities. Now for the total liabilities, we have current liabilities, of which the total current liability we have is 543. Then you add long-term debt, that's the non-current liability, of which we have it's 531. Then you divide by the total assets. You're already given the total assets, which is 33, 73. Then you multiply by 100. You have 31.84%. Let's do the same for 2012. 2012, you take the current liability, the total current liability we have is 540. Then we have long-term debt, which is 457. And then you divide by the total assets. The total asset we have is 35.88. And then you multiply by 100%. And that will represent a proportion of 27.88%. Now, what does it mean? In case we are taught to interpret, that means in 2011, the total debt represented that 1.84%, that 1.84% of the total asset. In 2012, the total debt represented 27.88%. So, in short, there is that reduction. So, what can make that have that reduction? You can say that in 2012, maybe we paid some debt. For example, in this case, you can see at 2011, the long-term debt was 531. Here we have it's 457. So there is that repayment of the debt. Number two, we have to compute equity multiplier ratio. Equity multiplier ratio. We have said that equity multiplier ratio shows the relationship existing between the total assets and the equity. And how do we get the equity multiplier ratio? So that is the total asset. You divide by the equity, and then you multiply by 100%. So in 2011, how much is the total asset? The total asset is the same as this, 3373. Here we had 3588. Then you divide by the equity. We divide by the equity. Now for the equity, we have owner's equity, where we have common stock. Common stock is equivalent to ordinary share capital. Then we have the retained earnings, and we have the total equity, which is 2299. 2299 times 100%. 2012, we have an amount of 2591 times 100%. What do we get? So here we have it's 146.7%, and here we have 138.5%. Lastly, number three, we have to compute the capital gearing ratio. Capital gearing ratio. Now, we said what is capital gearing ratio? We said that capital gearing ratio is the same as debt to equity ratio. Debt to equity ratio. It's better for you get all the names. For example, debt ratio is the same as financial gearing ratio. Then debt to equity ratio, capital gearing ratio. And how do we get the capital gearing ratio? We say that you take long-term debt, that's the non-current liability, you divide by the equity, then you multiply by 100%. The non-current liability, we had the long-term debt, long-term debt as 2011, we had an amount of 531. Then 2012, we had 457. And then you divide by the equity. Yeah, here we had the equity. And the equity here we have is 2299. And then you multiply by 100%. And here we have is 2591 times 100%. And here we have 23%. Here you have 17.64%. As simple as that. So that's how you evaluate that. So now let's go to the fourth category of ratios. That's the profitability ratio. Now, profitability ratio, it indicates the ability of the company to generate returns in relation to sales and investment. And for profitability ratio, they are classified into two. You see, we see in this case, we are saying that it indicates the ability of the company to generate returns in relation to sales and investment. So that means you can measure profitability from the income statement. Also, you can measure the profitability from the statement of financial position. That means for the sales, that's for the income statement. Investment is the statement of financial position. So they are classified into two. Number one, we have profitability in relation to sales. Now, in relation to sales, how do you get the gross profit margin? And the gross profit margin, you just take the gross profit, you divide by the sales, you multiply by 100%. Operating profit margin. Now, operating profit is the earning before interest and tax. Yeah, you take EBIT, you divide by the sales times 100%. Number C, we have the net profit margin. Net profit margin, that's you take the profit after tax, you divide by sales. Then operating expenses ratio. Now, all the expenses in the company, they are known as operating once you exclude the interest. Interest is not part of operating, it's part of the financing. So therefore, to get the operating expenses ratio, you take the total expenses, you deduct the interest expense, then you divide by the sales times 100%. Now, what you can note that all the denominator are the sales, and then they are always expressed as percentage. Now, the second category is the profitability in relation to investments. Number one, we have return on investment, or ROI, or return on total assets. So how do you get the return on investment? You take the net profit, or the profit after tax, you divide by the total asset. Number B, we have return on equity, or return on net worth. You just take the profit after tax, you divide by the equity. Number C, we have return on net asset. When you talk about the net asset, it's asset minus current liability, or non-current liability, non-current liability plus the equity. It's also known as the return on the capital employed. So therefore, to get the return on capital employed, you take the net profit, you divide by the net asset, or the capital employed. Then number five is the last category of ratios. And the last category of ratios was the activity, or efficiency ratios, or turnover ratios, or asset utilization ratio. Now, what are turnover ratios? Now, those are the ratios which are used to determine how well the company utilizes its assets. It's all about the asset utilization. It shows how the company is utilizing their assets. And number one, we have the stock or the inventory turnover. Now, these are the ratio which used to show how the company is converting, or the frequency into which the inventory is being converted into cash. So number one, you have the stock or inventory turnover. How do you get the stock turnover? You just take the cost of sales, you divide by the average stock. And how do you get the average stock? To get the average stock, you take the opening stock plus the closing stock, you divide by 2. Whenever you are not given the opening stock, closing stock will be regarded as the average stock. Let me repeat again. To get the average stock, you take the opening stock plus the closing stock, you divide by 2, that's how you get the average stock. Or, whenever you're not given the opening stock, the closing stock will be deemed to be the value of the average stock. Then number B, you have the debtors or the receivable turnover. You take the credits, it shows the frequency in which the customer are buying the goods on credit. That's what you call the receivable turnover. Frequency in which the customer are buying the good on credit. So therefore, you take the credit sales, you divide by the average debtors. How do you get the creditors turnover? Creditor turnover, you take the credit purchases, you divide by the average creditors. Then you have the fixed asset turnover ratio. For the fixed asset, you take the sales, you divide by the fixed asset. And lastly, we have the total asset turnover or investment turnover. You take the sales and then you divide by the total asset. You see, this one is the fixed asset. This one is the total asset. So that's the difference between the two. So now with that, I want us to do an illustration from our past paper. We can do an illustration. So open with me May 2017, question 4A. May 2017, question 4A. So we are doing that question, May 2017, question 4A. And we are told that the following are the summarized financial statement of Bakosa Limited. So Bakosa Limited statement of financial position. So we are given the statement of financial position for the 2 years. That's 2015 and 2016. Then we have Bakosa Limited income statement for the year ended that 1st December 2015 and 2016. Also we are given for 2 financial year. Then under the notes, you are given the retained profit brought forward. And then we have dividend paid during the year. Required, number 1, for each of the 2 years, you calculate, for each of the 2 years, number 1, you get the earnings per share. For each of the 2 years, so we have year 2015 and 2016. (2015, 2016). So number 1, we have to compute the earnings per share. How do we get the earnings per share? We say that to get the earnings per share, you take the profit attributable to ordinary shareholders, that's the profit after tax, minus the preferred dividend, then you divide by the number of ordinary shares. So we take total earnings attributable to ordinary shareholders, that's the profit after tax minus preferred dividend in case there is any. Then you divide by the number of ordinary shares. So what do we have? So we have the profit after tax. Now let's go to the income statement. The second part, we have the income statement. Under the income statement, there is profit for the year. We are not given the preference dividend, so that means there was no preferential capital. So therefore you have the profit for the year. 2015 was an amount of 9520. 2016 was an amount of 11660. Then you divide by the number of ordinary share. So you are not given the number of ordinary share, but we can get. So to get the number of shares, so how do we get the number of ordinary share? Now let's go to the ordinary share capital. Ordinary share capital. Now under the equity, we have the called up share capital, of which the par value is shilling 0.25 per share, of which for 2015 and 2016, both of them is 9920. So you'll take 9920. Now that's the share capital. You divide by the par value, which is 0.25, so that now you can be able to determine how many ordinary shares does the company has. And you get an amount of that 9,680. That 9,680. So therefore, you divide by the number of shares. That 9,680, that 9,680. For the 2 financial year, the number of the share or the share capital was the same. 0.24, here you have 0.29. That's number 1. Number 2, we are to get or to determine the dividend cover. And we say that the dividend cover shows the number of times which the dividends are paid out of the earnings. So therefore, you take the earnings per share, you divide by the dividend per share. We already have the earnings per share. That's what we have computed in number A. This is 0.24, 0.29. You divide by the dividend per share. How do we get the dividend per share? We say that to get the dividend per share, you'll take the total dividends, you divide by the number of shares. Total dividend over the number of shares. So we compute for 2015, 2016. Now let's go back to where we have the notes. Let's go where you have the notes. Where you have the notes, Note number 1 was the retained profit. Number 2, we have the dividend paid during the year. 2015, we paid a total dividend of 2240. 2016, we paid an amount of 2400. Those are the total dividend. Then you divide by the number of shares. For the 2 financial years, the number of ordinary share here we have it's 39,680, 39,680. And what we get? So here you have it's 0.06. Also here, you are getting almost the same, 0.06. Good. So therefore here we divide by 0.06, 0.06. Yeah. So what do we get? So, and you see that the dividend cover shows the number of times. So your answer should be in times. So here you have 4 times. Here you are getting 4.83 times. Good. Number 3, you have to compute the current ratio. And we say that current ratio is current asset over current liability. Let's compute that. Current asset over current liability. 2015, the total current asset, we have it's an amount of 92,447. In 2016, we have the total is 99,615. That one you already given. Then you divide by the current liabilities. For the current liabilities in 2015, we have the account payable taxation, of which the total is 36,862. In 2016, we have it 42,475. That's how we get the current ratio. And what we get? So here you have an amount of 2.5 times. And here we have 2.35 times. Now what do we say about the current ratio? We say that the recommended current ratio should be 2 times or 2:1. You see in this case it's 2.5. That means in terms of the liquidity, the company is performing better, as well as also in 2016 it's more than 2 times. So therefore the company is performing better in terms of liquidity. They are more liquid. Then number 4, number D, we have to compute the acid test ratio. Acid test ratio. And we say that acid test ratio is the same as the quick ratio. Quick ratio. And how do we get the quick ratio? Is the current asset, but you deduct stock. You divide by the current liability. So it's 92,447. Then you raise stock. Stock for 2015 was an amount of 40,145. Then the current liability does not change. We had an amount of 36,862. 2016, you take the total assets, which is 99,615. You deduct the inventory. At inventory, as per 2016 financial year, we had an amount of 50,455. And then you divide by current liability, 42,475. And here we have is 1.42 times. Here we have it's 1.16 times. Or you can write them in ratios. Yeah, for example, in this case, it's not a matter that you have to write 1.42 times. It's the same as 1.42:1. What do we say about the quick ratio? We say that for the quick ratio, the recommended ratio for the company is 1:1. But in this case, you see we have more than 1. So that means in terms of liquidity, also the company is performing better. Then lastly, number 5, we have to compute return on capital employed. How do we get return on capital employed? We say that to get the return on capital employed, you take the net profit or the profit after tax, you divide by the capital employed or the net asset. Net asset or the amount of capital employed, then you multiply by 100%. So how much was the net profit? For the net profit, let's go to the income statement. For the income statement, we have profit after tax. And the profit after tax, here we had is 95.20. Here we have it's 11,660. Then you divide by the net asset. Net asset. Now let's go to the balance sheet. The first statement you have is the balance sheet. Under the balance sheet, you are given the net asset. That's the current assets minus liability. You have the net asset, of which the net asset here we have it's 4740. And you multiply by 100. 2016, it's an amount of 50,000 times 100%. And in that case, what we have, so here we have is 23.37%. Here we also have 23.32%. So that's how you compute that. So I want you to go and try this question. May 2019, question 3B. This question is already in your notes. So once you try, you can also then, you can mark for yourself from the notes. You can mark from yourself on your notes.